I see women over 40 make the same 5 investing mistakes over and over again, and these mistakes cost them thousands of pounds and years of wealth building. So if you're a woman over 40 and you have money that is just sat there in a savings account, but you do not know what to do with it, you need to hear these 5 mistakes before you make them. Because I'll be totally honest, I have made some of these mistakes myself, and I've also watched my clients made these same mistakes, and to be honest, every single one of them was completely avoidable. So let me save you the time, let me save you the money, let me save you the stress, and let me save you the regret, because here are the 5 biggest investing mistakes that women over 40 make. If you've not seen me before, my name's Harriet, and I have built a 6-figure investment portfolio from scratch. And now I help women over 40 turn their savings into wealth through investing. And also, along the way, I have seen these mistakes cost women tens of thousands of pounds. So let me break them down for you one by one, starting with the most expensive one. So mistake number 1, waiting too long to start investing. This is hands down one of the most expensive mistakes. Not because you lose money, but because you lose time. And time is the most valuable asset that you have when it comes to investing. You cannot get time back. And honestly, I hear this all of the time from the women over 40 who I coach. I'll start investing when I have more money saved up. I'll start investing when I understand everything. I'm too old to start now. I don't know what to do, so I'm just not going to do anything. And here is the brutal truth, and hear me when I say this. While you are waiting, your money is losing value to inflation. While you are waiting, compound interest is working for somebody else and not for you. So let me give you a real life example. Let's say that you're 40 years old. If you invest £500 a month and you get an average of an 8% return, which is typical for the stock market, like over the long term, by age 65, you'll have around £456,000. But if you wait just 5 years and you start at age 45, you're going to have £284,000. That 5 years of waiting time cost you £172,000. That is the cost of, I'll do it later. If you wait until you're 50, you'll have £183,000. And that is honestly the difference between starting at 40 vs starting at 50, £273,000. And honestly, I wish I started at 18. I wish my mum started me with a junior ISA from birth. But listen, I can't change that. But what I can change is what I do with the time that is left now. That is what counts. And the same is true for you also. You cannot get back the years that you've already wasted, but you can start today. So if you're over 40 and you haven't started investing yet today, honestly, don't wait. Don't say, oh, I'm going to do it next month, not next year. Do it today. You don't need thousands of pounds in order for you to start, and you do not need to be an expert. You just need to start. Mistake number 2. Investing in things that you don't understand. And this is the mistake that causes people to lose like real-time money. And I see women do this all of the time. They want to invest in cryptocurrency because everybody's talking about it. It's the dumb thing to do. Or buying individual stocks because a friend recommended it. Or putting money into complex investing products that they've never heard of before, but a friend has recommended it. However, they don't really understand it. They're only doing it because somebody recommended it to them. And honestly, that is when things start to go wrong. That is when they start to panic. And then what happens is you sell at a loss. And then you start thinking to yourself, see, I knew investing wasn't for me. No, bad investing isn't for you, but smart investing absolutely is. So here's the rule. I only invest in things that I understand. If I can't explain or understand what it is or how it works, honestly, I do not put my money there. And for me, this means investing in simple index funds, simple, diversified, low-cost index funds. I understand them. I know what it is that I'm buying, and I know that they work. And an index fund is basically just like a basket of hundreds of companies. So instead of trying to pick the winning company or the winning stock, you just buy a little bit of everything. So index funds, yeah, they're boring. They're not sexy. They're not exciting. But they work. And honestly, it's about what works is what matters. So if I didn't understand index funds when I first started, I'll be honest, And I took time to learn about them. And once I understood how simple and how effective they were, that's where I started to put my money. I was like, let's keep it simple. So before you invest anything, ask yourself, do I actually understand this? And how does this make me money? And if the answer is like you don't understand it, then don't invest in it. Learn about it first. Mistake number 3, panic selling when the market drops. I've had clients literally call me in tears because their investments have dropped like 15% in a month, and they like, Harriet, I just want to pull everything out, and then they just want to save whatever money is left in there. And I've literally had to talk them down from a ledge, because this is one of the worst things that you can do. The absolute worst thing that you can do, because when you sell during a market drop, you're actually locking in your losses. You turn a temporary loss into a proper permanent loss, like into a real life loss. And because here's what always happens, the market always recovers. It always does. It might take weeks, it may take months, it may even take like a year or two, but ultimately it is going to recover. And if you've sold your stocks in a panic, you're going to miss out on the recovery. So here's what you need to understand. The stock market is volatile. It is absolutely volatile. It goes up and it goes down, and that is to be expected, and that is a part of investing. So if you're investing for the long term, and if you're over 40, you should be investing for the rest of your life. These short-term drops, honestly, they don't matter, because you are investing for the long term, not for the short term. In the short term, yes, it's going to go up and down, but over the long term, it is gradually going to be going up. And in fact, when the market dips, it's actually an opportunity. So when the market drops, you're actually buying it at a discount. So think about it. If your favourite shop, say for example, they had like a 20% sale, what would you do? Run away? No, you'll go buy more. Same with investing. Here's my rule. I only invest money in what I don't need for at least the next 10 years. That way I can ride out the ups and downs without panicking. And to be fair, I'm investing for the rest of my life. So if you're going to panic, and sell for the first time, until the first time that your investment drops, you need to work on your mindset before you start investing. Mistake number 4, poor diversification. Or that means putting all of your eggs in one basket. So when I first started investing, I bought individual stocks. I didn't understand index funds yet. So I thought, I didn't really understand what investing was. So I thought it was just like picking companies. But because I didn't fully understand about diversification, all of my money was just in a handful of companies. And the thing is, if those companies did badly, then the whole of my portfolio did badly. So real diversification means basically just spreading your money across different companies. It could be like different countries like the UK, the US, global markets, emerging markets. It could be different sectors, tech, healthcare, energy, finance. Different types of investments, so like stocks and bonds. That's just giving you an idea. Like, you're not just focusing on one thing, you've bought it all. So that's why index funds are so powerful. When you buy one index fund, you're already diversified across hundreds and thousands of companies. So if one company fails, you've still got hundreds of others that are balancing it all out. Think of it this way. If you had £10,000 to protect it, would you hide it all just like in one spot in the house? Or would you spread it across like different rooms and different places? You would spread it across different places, because the same principle starts classes with investing. Spread your risk. Now, I'm not going to tell you exactly how to split your money. That's something that you need to figure out based on, your own risk tolerance and what your goals are, because for everyone it is going to be different. But I will tell you this. Don't put all of your money in one place. So whether that is one stock, one fund, or one country, spread it out. And finally, mistake number 5, ignoring tax efficient accounts. This is the mistake that I see people make all of the time, and it is so easily avoidable. So a lot of women don't realize that when they invest, it matters just as much as where you're putting your money in the account that you use. So say for example, if you are investing in the UK and you're not using a stocks and shares ISA, first, you are leaving money on the table. Here's what you need to know. With a stocks and shares ISA, you can get a £20,000 allowance every single tax year, and any gains that you make, it is absolutely tax-free. Any dividends that you earn, tax-free. The government is literally saying, invest here and we are not going to tax you, because trust me, they like to tax us everywhere else. Another one, workplace pension. So your contributions get tax relief. Your employer matches your contribution, so it's literally free money. Honestly, free money. free money, and honestly, it grows tax-free until you retire. If you use a general investment account instead of an ISA, you are going to pay capital gains tax on your profits, and that could be hundreds or that could be thousands of pounds that could have literally stayed in your own pocket rather than going to the government. And as I said, the government really likes to tax us for everything else. So there is no reason for you to use a general investment account if you have not maxed out your ISA allowance or your pension contributions first. And it's like choosing to pay full price when there's a discount code available, and who doesn't like a discount? Why would you want to do that? So please use your tax efficient accounts first, so your ISA and your pension. So those are the 5 biggest mistakes that women over 40 make with investing, and here's what to do instead. So number 1, start now. Even if you do not feel ready, even if it's just £25 or £50 a month, start today. Number 2, only invest in things that you understand, and for most people that is just a simple low cost index fund. Number 3, when the market drops, do not panic, keep investing, just trust the process. Number 4, make sure that you are properly diversified, do not put all of your eggs in one basket. And number 5, use your ISA and pension first before you do anything else. If you do these 5 things, you'll be miles ahead of what most people are. Now, if you're a woman over 40 and you've just got money just sat there in your savings account and you do not know what to do with it, I have got something for you. I'm going to be running a free masterclass called First Steps to Investing, and in the masterclass I'm going to show you how to get started even if you've never invested before. And even if you feel like a bit overwhelmed, you're just like, I want to invest, Harriet, but I just don't know where to start, this masterclass is going to be just for you, and it's going to be the perfect next step if you actually want to finally do something about money that is just sat there in your savings account, just losing money, money to inflation, or should I say losing value to inflation. And honestly, it's completely free. All the details and the registration link are in the description box below. So if this video has helped you, or if it's given you some insight, please do give it a thumbs up, and make sure that you subscribe if you haven't already, and drop a comment below telling me which one of these mistakes have you made or are you worrying about making. Let's learn from each other. I'll see you in the next one. Let's build that wealth together.